What's the break-even point of a covered straddle? Have you ever wondered how to determine the break-even point of a covered straddle in options trading? Let's break it down in a simple way. A covered straddle is an options strategy where an investor owns the underlying stock and sells both a call option and a put option at the same strike price. This strategy can generate income through premiums but comes with its own risks. To find the break-even point, you need to consider the stock purchase price and the premiums received from selling the call and put options. The break-even point is where the investor neither makes a profit nor incurs a loss. First, let's look at the basic calculation for the downside. You can find the break-even point by taking the stock purchase price and subtracting the total premiums received. This means the stock price can drop below the purchase price by the amount of the premiums collected before you start losing money. However, keep in mind that losses can escalate quickly below this point due to the short put position. Now, for a more precise calculation, you can consider how losses accelerate. The formula for this is to take half of the sum of the strike price, stock purchase price, and subtract the total premiums received. This accounts for the fact that losses on the downside grow faster because of the combination of the stock and the short put. In practice, a covered straddle has two break-even points, one on the upside and one on the downside. The upper break-even point is calculated by adding the total premiums received to the strike price. The lower break-even point is found by subtracting the total premiums received from the strike price. For example, if you bought stock at $50, sold a call and a put both with a strike price of $50, and received $5 in total premiums, your break-even points would be $55 on the upside and $45 on the downside. If the stock price stays between $45 and $55 at expiration, you keep the premiums and avoid losses. However, if the stock price moves outside this range, losses can begin. The downside losses can be more severe due to owning the stock and the short put exposure. So, the break-even point of a covered straddle is determined by the stock purchase price, the strike price of the options, and the premiums received. This defines the price range within which the strategy is profitable. Understanding these calculations can help you navigate options trading with more confidence.